The money in your bank account is not what you think it is. This is not symbolism. It is not a theory. And it is not paranoia. It is a structural reality. If every customer tried to withdraw their money at the same time, the system would fail almost immediately, not because of panic, but because the money is not actually there. It never was. This fragility is not a bug in the system. It is the system. At the core of modern finance lies a mechanism so normalized that most people never question it. It is called fractional reserve banking, and it quietly powers global debt, chronic inflation, and the illusion of prosperity. Once you understand how it works, one fact becomes impossible to ignore. Modern money is built on promises that cannot all be honored at once. To see how this began, we need to return to a world before apps, before credit cards, before digital ledgers. In medieval Europe, wealth was tangible. Gold and silver coins, jewelry, physical assets you could hold, hide, or trade. But carrying large amounts of precious metal was dangerous. Theft was common. So people turned to goldsmiths, craftsmen who owned secure vaults. You would deposit your gold with a goldsmith, and in return, receive a paper receipt. That receipt promised that whoever held it could come back and reclaim the gold. Over time, something subtle but revolutionary happened. People stopped redeeming the receipts. They began trading them instead. The paper was easier to carry than metal, and everyone trusted that the gold was there. That trust is where everything changed. The goldsmiths noticed a pattern. Out of hundreds of depositors, only a handful ever came to withdraw their gold on the same day. Most of the metal sat untouched, day after day. So the goldsmiths took a risk. They issued more receipts than they had gold. If they held 1,000 coins, they might circulate 2,000 claims. Those extra claims were loaned out at interest. As long as everyone did not ask for their gold at once, the illusion held. Wealth had been created not by mining or labor, but by issuing promises. This was not a minor innovation. It was a turning point. The moment society accepted paper claims as equivalent to real assets, money became detached from physical limits. Banking was born. By the 17th century, governments embraced this model. The Bank of England, founded in 1694, was not created to protect citizens or promote stability. It was created to finance war. The crown was deeply indebted, and the bank solved the problem by lending money it did not fully possess. In return, it received interest paid not by kings but by taxpayers. Generation after generation, this pattern became permanent. Governments discovered they could spend now and pay later. The future would absorb the cost. The United States followed the same trajectory. Early American banks issued paper notes redeemable in gold, but soon learned the same lesson as the goldsmiths. Redemption was rare. So they printed more notes than they could cover. Periodically, reality intervened. Bank runs erupted. Depositors rushed to withdraw their money, only to discover it did not exist. Banks collapsed overnight. Instead of dismantling the system, governments reinforced it. Central banks were created to stabilize confidence. Their role was simple: ensure the public continued to believe. Fast forward to today. Imagine depositing $100 into a bank. You assume that money sits safely waiting for you. In truth, the bank historically kept only a fraction, perhaps $10, and lent out the rest. That loan would be deposited elsewhere, re-lent again and again, multiplying the original deposit into nearly $1,000 of circulating credit, but only a small portion ever existed as actual cash. The rest was debt. And even that explanation is outdated. Since March 2020. Banks in the United States are no longer required to hold any reserves at all. Zero. Nothing. So what prevents infinite lending? The constraint is no longer reserves. It is regulations, specifically capital and liquidity requirements under the Basel framework. These rules, written by central bankers and regulators meeting in Basel, Switzerland, dictate how much risk banks can take and how much equity they must hold to absorb losses. Banks today do not lend deposits. They create loans first. The loan itself generates a deposit. When you receive a mortgage, no money is transferred from a vault. New money is created digitally the moment the loan is approved. Only afterward does the bank ensure it meets regulatory ratios. This is why over 90% of the money in circulation is not issued by central banks. It is created by commercial banks as debt. Your bank balance is not the same kind of money as physical cash. It is a claim on a bank, backed by confidence. And this system produces unavoidable consequences. First, inflation. As credit expands, purchasing power erodes. Prices rise not only because of scarcity, but because currency itself is diluted. Second, perpetual debt. Because money is created as loans, there is always more debt than money available to repay it. Interest guarantees imbalance. Someone must default, refinance, or borrow more. Third, concentration of power. Banks earn interest on money they create. Governments finance spending without immediate taxation. Asset owners benefit as inflation drives prices upward, while wages lag behind. Every crisis exposes the same weakness: the Great Depression, the collapse of 1929, the financial crisis of 2008. Each time, excessive credit expansion met reality. Confidence broke, and each time the response was identical: rescue the system at all costs. Because without it, the modern economy stops. Here is the uncomfortable truth: the system cannot function if everyone becomes debt-free. If all loans were repaid tomorrow, the money supply would contract violently. Growth would vanish. The engine depends on borrowing. You are not just a participant. You are the collateral. So what does this mean for you? It means money is not wealth. Wealth is productive land, real assets, skills, resilience, and autonomy. It means debt is not neutral, it is structural. And inflation is not accidental. It is designed. This is not a call for panic. It is a call for awareness. Every financial system in history has relied on belief. And belief is fragile. Understand the mechanism, and you can begin to protect yourself from it. Ignore it, and you remain trapped in a game where the rules were written long before you were born, and where the house always wins. If this changed how you see money, subscribe. History already gave us the answers. You just need to know where to look.